75% annual interest. That's what Roman pawnbrokers charged in Pompeii, 2,000 years before payday lending became a modern controversy. And here's what nobody tells you. The Roman Empire experienced a full-scale banking crisis in 33 AD. Credit dried up overnight. Property values collapsed. Senators lost their entire fortunes. Sound familiar? It should. Emperor Tiberius responded with the first government bailout in recorded history. 100 million sesterces of emergency lending. That's roughly $500 million to $1 billion in today's money. I'm going to show you the ancient sources that document exactly what happened, and why the same crisis mechanism is still operating in modern economies right now. First, let's understand how Roman banking actually worked. The argentieri, Roman bankers, weren't like modern financial institutions. They operated from small shops around the Forum. They accepted deposits from clients. They made loans at interest. They transferred funds across the empire using letters of credit. But here's the critical difference from modern banking. There was no deposit insurance. If your banker made bad loans and failed, you lost everything you had deposited. There was no government guarantee. No protection whatsoever. When a Roman bank collapsed, depositors simply lost their money. This created a fundamental fragility in the system that made periodic crises essentially inevitable. The standard interest rate in Rome was 12% annually, 1% per month. Romans called this centesimae usurae, the 100th interest. For context, that's similar to what modern credit cards charge. Romans figured out consumer lending 20 centuries ago, but 12% was only for respectable clients with good collateral. For desperate borrowers, people who needed money immediately with few assets to pledge, the rates were dramatically higher. Pawnbrokers operated in every Roman city, offering quick cash at rates that would be illegal in most modern countries. And we have the actual documentation to prove it. Let me show you the evidence. Archaeological excavations have recovered Roman loan documents from across the empire. But the most detailed records come from Pompeii, preserved by the same volcanic eruption that froze the city in time. These tablets record exact interest rates charged to specific borrowers: 12% for secured loans, 24% for unsecured personal loans, 48% in provinces where lenders faced higher default risk, and in emergency lending situations, rates routinely exceeded 50%. Some tablets record 75% annual interest. These aren't estimates or speculation. These are actual contracts, preserved for 2,000 years. The Romans didn't invent predatory lending, but they definitely systematized it. But here's where it gets interesting. High interest rates were just the symptom. The underlying disease was systemic. Rome's entire economy ran on credit. Senators borrowed money to fund political campaigns. Merchants borrowed to finance trade voyages. Farmers borrowed against next year's harvest. When credit expanded, everyone prospered. When credit contracted, the entire economic system could collapse. In 33 AD, credit contracted hard. If this kind of investigation, tracing financial systems through history, is new to you, you're in the right place. Subscribe. The crisis started with a law. In 33 AD, Emperor Tiberius decided to revive an old statute that had been ignored for decades. The law required Roman citizens to invest a certain portion of their capital in Italian agricultural land. The intention was to support farming. But the law had been ignored. Then, informers saw an opportunity. They began reporting violations. Suddenly, wealthy Romans faced prosecution. Stop. Think about what this means economically. Every wealthy Roman now had to convert their liquid assets, their loans, their deposits, their investments, into Italian real estate. All at the same time. What happens when everyone tries to sell the same assets simultaneously? You get a liquidity crisis. Roman lenders started calling in their outstanding loans. Borrowers who couldn't immediately repay faced foreclosure on their collateral. Foreclosed properties flooded the market, causing real estate values to collapse. The collateral backing other loans became worthless. Banks that had seemed stable suddenly faced insolvency as their assets evaporated. Credit markets froze completely. The ancient historian Tacitus recorded the chaos in detail. Senators who had lived in luxury suddenly faced financial ruin. Estates were being sold at fire sale prices. The courts were overwhelmed with debt collection cases. No one could borrow. The economy was frozen. This is the exact cascade sequence that occurred in 2008. Credit contraction triggers asset fire sales. Fire sales crash collateral values. Crashed collateral causes bank failures. Bank failures freeze lending. Think about it. If your savings had been deposited in a Roman bank that failed, you lost everything. The same fundamental fear still drives bank runs today. Quick question. Have you ever worried about whether your money is really safe in a bank? Type yes or no in the comments. Emperor Tiberius faced a decision. Let the crisis burn through the economy, or intervene with government resources to stabilize the system. He chose intervention. 100 million sesterces from the imperial treasury. Interest-free loans for 3 years. Available to borrowers who could pledge land worth double the loan amount as collateral. This was quantitative easing, Roman style, injecting liquidity into a frozen credit market. The exact strategy used in 2008 and 2020. And they said, modern financial crises are unprecedented. This proves governments have been bailing out economies for over 2,000 years. Let's examine the bailout mechanics. 100 million sesterces represented a massive commitment. Roughly $500 million to $1 billion today. Tiberius didn't give this money away. He lent it, interest-free, meant no profit for the treasury, but no additional burden on borrowers. The double collateral requirement meant only people with real assets could borrow. It prevented speculation with government money. The design was actually quite sophisticated. It provided liquidity to the frozen system without creating significant moral hazard. Did the bailout actually work? In the short term, absolutely. Credit started flowing again. Property markets stabilized. Senators recovered their estates. But here's what Tacitus also records. The underlying problems remained completely unaddressed. Predatory lending continued exactly as before. Wait, I know what you're thinking. So nothing actually changed. Exactly. And that's the critical lesson. Government bailouts solve liquidity crises. They don't solve structural problems. Rome bailed out its economy in 33 AD. Rome experienced crises repeatedly afterward. This is the evidence that ties everything together. The Roman legal code included interest rate caps going back centuries, but the archaeological record clearly shows that caps were routinely violated. Lenders found workarounds. Emergency lending was effectively exempt. Complex arrangements disguised true interest rates. Remember those Pompeii pawnbrokers charging 75%? Technically illegal, but actually common. This is the callback. Legal interest rate caps have consistently failed for over 24 centuries. The same debate happening today was happening in ancient Rome. But we're not finished. Because behind every credit crisis are real people. The senators Tacitus mentions were families who saw wealth evaporate. Consider what a Roman banking collapse actually meant for ordinary people. If you were a craftsman and your banker failed, your savings were gone. If you were a widow depending on interest income, you faced destitution. If you were a young entrepreneur, your business collapsed. The economic statistics describe aggregate phenomena, but behind every percentage point were individual lives disrupted and futures foreclosed. The wealthy senators eventually recovered their estates after Tiberius' intervention. The system stabilized. But what about the people who couldn't access those government loans? They were excluded from the bailout entirely. They don't teach this complexity in economics class. Bailouts often save systems while leaving vulnerable individuals to absorb losses. Have you experienced a financial crisis where institutions were rescued but individuals weren't? Share your experience in the comments. Here's the modern parallel. 2008, banks had extended too much credit. Housing prices crashed. Collateral values collapsed. Credit markets froze. The government response was massive bailouts. TARP, quantitative easing. The mechanism was identical to 33 AD. Tacitus could have written the 2008 financial crisis coverage. Check your own financial accounts. The same fragilities exist in modern institutions. According to Federal Reserve data, the 2008 crisis followed precisely the same pattern as Tiberius' response: liquidity injection to frozen markets, emergency lending, but structural vulnerabilities in the financial system remained largely unaddressed. Remember the interest rate caps. Remember the bailout mechanics. Legal restrictions have consistently failed. Bailouts consistently save systems without fixing fragilities. You will live through more financial crises. That's not pessimism. That's historical probability. Subscribe to understand how ancient economic cycles are still running. So now you understand. Roman banking wasn't primitive. It was sophisticated, and it experienced the same crises we do. We're not repeating Rome's mistakes because we don't know history. We're repeating them because the patterns are inherent to credit-based economies. I think the cycle isn't a bug in capitalism. It's a feature. Tell me I'm wrong in the comments. But you can't unknow what I've shown you. Every Federal Reserve announcement, you'll recognize the pattern now. But this story connects to something even bigger. The same credit system that created these crises also funded Rome's imperial expansion. When the credit system worked, Rome conquered. When credit failed, expansion stopped. How Roman finance and military power were connected. That's my next investigation. If these investigations matter to you, subscribe. Click here for our investigation into how credit funded Rome's rise.